Did you know that trading without a plan is the #1 reason most traders fail to succeed in the markets? With so much riding on a plan, you would expect that every trader would have one. However, with most advice on writing a trading plan being so overcomplicated, the reality for most traders is that writing a plan can feel more like an exercise in analysis paralysis than in creation, as you look for what to include and find that every source of information only adds to the complexity and confusion. So in this video, I'll show you an incredibly simple 5-part trading plan that you can apply as a template for your trading, and go from dreaming about making a plan to having a simple, well-organized document that's easy to follow and is fit for a professional trader. Number 1, the market and instruments. For most traders, the market and instruments they trade are whichever ones have recently caught their attention. Unfortunately though, this jumping around from market to market and instrument to instrument keeps them from succeeding, with never enough time spent in any one market or instrument to really learn about and become good at trading it. A great way to make sure your trading is staying focused is to have section 1 of your plan dedicated to narrowing down the market and instruments you will trade. By choosing to focus your attention up front, your plan will keep your attention on the specific market and instruments you want to truly become an expert at trading. Number 2, the time frame. Quite possibly the most frustrating choice in your trading. Deciding on the time frame that you will use to make your decisions is something that gives many traders a huge amount of difficulty. This is because there are so many time frames to choose from, and so many sources arguing for the merits or pitfalls of each, that it can become completely overwhelming. And many traders resort to jumping from time frame to time frame because of this. What you need is a simple section number 2 in your trading plan that narrows down exactly which time frames you will use to make your trading decisions. This is a great way to keep your analysis consistent and effective, and it will keep your strategy much more simple overall when it is focused on just 1 or 2 different time frames that you have pre-selected as the ones you will use. Number 3, the entry. Whether you have a system you sometimes follow or you're just spinning a coin and picking a side, there's no escaping the fact that every trader has to eventually decide when to enter a trade. The problem is that not having exact entry rules means every trade is completely random. And unless you're extremely lucky over and over again, these random entries are likely to make your trading feel more like a game of chance rather than the true application of planned speculation. An elegant solution for making your trades quantifiable and at the same time easy to analyze after the fact is to have section number 3 in your plan, where you list clear entry rules that you will follow to make each trade. This way, you'll always have an exact checklist of rules that must be met before you place a trade, and you'll have a crystal clear vision of how your trading analysis is actually working in the markets. Because with clear rules to follow, you can also accurately test your strategy. Number 4, the stop loss. Putting on a stop loss for every trade you make is one of those things that you've heard about a million times. And if you're like most traders, you probably do put on a stop loss most of the time, but each time there is a varying level of risk. And when your stop loss hits and you lose more than you wanted to, you kick yourself for putting on that much risk. A simple solution is to have section number 4 of your plan where you write down your exact rules for putting on a stop loss for each and every trade you make, and the maximum percentage of your total account value this stop loss can risk. This way, there can be no surprises, and you will find yourself building the stop-loss habit with greater ease. Number 5, the exit. Once we have a trade going in our favor, the tendency can be to either take it off far too early or to not take it off at all, letting it go from a position of profit to right back where the trade started, or worse. However, there is an easy solution to this problem. By having section number 5 in your plan, where you write down how you will exit your winning trades using trailing stops, profit targets, and early exit signals, you can turn typically difficult to end trades back into successful, profitable exits. Another neat hack is to make sure you plan out your potential profitable exit as soon as you have placed your entry and stop loss orders. That way, you've already got your action plan for the trade in place, and then all you have to do is sit back and manage the trade according to your plan. To get more trading solution videos like this, hit the like and subscribe buttons and leave a comment below to let me know what you'd like to see next.